Hello, everyone. My name is Gerard Vecchio. I'm a managing director and head of all of specialty at Marshberry. I'd like to welcome you all to today's Viewpoint. Today, we have David Paul returning to discuss with us today the insurance markets. David is principal of insurance research at Alert and a partner at Alert Research. David, I'd like to kind of start by being somewhat dramatic and kind of set the stage in terms of how much the industry from a macro point of view may or may not have changed given what has gone on in the world since the last time we spoke, probably 3 or 4 months ago in this on this channel. You know, we have interest rates now at the highest level we've seen in 30 years. We have claim costs going up because of inflation. We have political upheaval, war in Europe. And at least with regard to the MGA side, we have uncertainty in that market because AM Best is now providing measurements of the financial stability of MGAs, and we just don't know or don't have certainty as to how that is going to affect the overall market. So with that as backdrop, David, you know, how do you react and what are you seeing that is happening in the carrier market in that context?
No, that's a great question. Thanks again for having me again. I would also throw in obviously large catastrophe losses that they continue to face every year as maybe the fourth item there. What's interesting is with all the doom and gloom that you just detailed, our results, and of course we're credit analysts looking at the financial strength of these of the industry and individual insurers. It almost hasn't been this good in a very, very long time. I think you'd have to go back probably to the 2004, 5, 6 timeframe after that last hard market to see some of the results we're seeing in terms of the financial performance of the industry. So it is kind of a tale of two cities here. Certainly the macro environment looks like doom and gloom, but in terms of the results coming through, they're very good. In the piece we wrote for year end, I think I wrote records everywhere as kind of the title of my little 2-page introduction. And basically just listening to the analyst calls from Chubb and Hartford and Travelers and all of the insurers really coming out with remarks like simply stunning across the board. That was from Evan Greenberg. I'm kind of looking at it here, firing on all cylinders, the best results ever, record revenues, et cetera, et cetera. So, listen, we've had 4 years of rate increases. Obviously, we had a blip with COVID. I guess that's probably an understatement for what we had, but certainly the economy came roaring back, in terms of exposure units have been growing. So we've really seen insurers take advantage of that rate increase on top of exposure unit growth to really drive some great returns. One of the issues we talk about a lot is the issue of return on equity. Now, of course, we're looking at statutory results. So we're really dealing with surplus in the regulated entities, but there's simply, if you want to call it too much, it's too much surplus in the industry. If these insurers want to get between a 10 and 15% return on equity, which is somewhat of a target, I think a target for the whole industry, maybe around 10% would be really attractive for the industry. It gets tough when you approach almost $1 trillion of surplus at year end now in the U.S. industry. And as they chase these returns on surplus, I'll call it, they're going to keep driving prices up to try to hit that bogey. And as they drive the prices up, of course, you put even more surplus in, and it becomes like a cat chasing its tail, trying to get to that return on equity or surplus bogey. So this becomes very problematic, and I'll tell you why. I was talking to a broker colleague the other day, a client, and we were just talking about what he's seeing in the industry, and he mentioned that they're doing a lot of work now with captives because prices have gotten to the point where captives become more attractive. And I asked him, I just said, hey, I'm not a producer, but once someone gets a taste of a captive, once rates settle down, do they tend to come back? And he said, hey, if they're good, they don't, right? Because they get used to obviously having the investment income, and they get to control I think they get to see that they can control their losses a little bit better and how that shows up kind of on the bottom line, et cetera. So this becomes an issue for the industry. If they ask for too much rate, they may end up losing some good customers for a long period of time, if not for good. So that's kind of what we're seeing. But in terms of individual alert scores, I'm putting a presentation together for a group of networks, and they asked me to look at the different regions and some of the results of regional mutuals and farm bureaus. I mean, they're close to 2 standard deviations above what's normal for us. So we're really seeing strong results. Hartford, Travelers, Chubb, even Zurich is showing the best results that we've seen in the last 5 years. So, we look at a lot of different carriers, obviously, and, there are pockets, certainly, if you're talking about Florida homeowners, one of the things that some of the InsurTech PC, which get a lot of press, obviously they're hurting, and there's other pockets of business. Certainly, we saw some carriers go out of business in Louisiana, et cetera, from some of these large losses. California obviously is dealing with fires on the personal line side, et cetera. But overall, across the country, we're seeing really strong results.
David, I'd like to pick up on one thing you said at the end there, or towards the end, which is with regard to the captives. Implicit in what you said was that the captives, those that are run well, and presumably those firms that also have loss ratios that allow the captives to continue, if you take them out of the market, presumably that surplus is not counted in your $1 trillion of surplus that you're measuring for the industry, because they're not in carriers and therefore they're not necessarily reporting in the same way. Well, implicit in that is, if you're taking good business out, what's being left is business that may just be not as good. We won't say bad business, but marginal business. And therefore, the carriers are trying to make a higher return on surplus with more surplus with marginal business. Doesn't that actually exacerbate the situation?
I mean, it's certainly theoretically what you said is true. It would exacerbate the situation. Again, we probably shouldn't overstate captives. It's not like they've taken, 20, 30, 40% of the business out of the market. But I was struck by, and obviously there are captive groups set up where it's really turnkey, right? So it's easy for a producer to go to one of these groups, and that captive will kind of set the whole thing up in a group captive, et cetera. Again, not my expertise, but from how he explains it, it sounds very turnkey. So it's become easier to do this. But theoretically, you're right. Yeah, I mean, it just becomes harder. I think at some point, whether it's through this kind of captive element or just brokers starting to push back, at some point, the rates are going to soften, and they're already, obviously, we're still getting positive rate increases, but they're not. They're kind of starting to go down, if you will, each period. So, but I think there's probably a long runway, and for the rates to go down, kind of back to neutral or something like that. And the reason is for some of the things you stated at the outset of the call, is that the insurers, are dealing with a lot of unknowns right now, right? With inflation like we're seeing now, we haven't seen that in very many years. How do you price business when you don't know what the ultimate cost is going to be? I understand that you kind of ask for more, hope to get as much as you can, obviously put up the IBNR, and if you can release it in the future, that's great. And I think that's one of the reasons we're seeing these results is there has been this idea that inflation was going to take off for a while, quite honestly. It really didn't until recently. And so all of that kind of extra padding that came in was able to be released. There's a lot of kind of known unknowns out there right now, right? So, and that's certainly playing a part in pricing. But, the insurers, I think, are taking these results, taking it while they can. And being an insurer, I don't blame them. I mean, I think they're going to hang on for as long as they can with these results. But I do think there's going to be growing tension, between additional rate in this environment when they're doing so well.
Well, it's an interesting admonition for Marsh Berry's core client base, which of course is insurance brokers. And, if they are properly representing their clients, they have to kind of balance between higher premiums, higher prices to offset greater risk. At the same time, keeping insurance carriers honest that if you have a good account that may not have had losses or have had minimal losses, or where the rates are otherwise more than adequate, we may be at that point in the underwriting cycle and the pricing cycle where the good brokers will differentiate themselves by pushing back on their carrier partners to say, you've got now you have ample pricing. You have to now, to keep these accounts, you have to work with us. Any thoughts there?
I think
Parting thoughts?
I do think you're right, and I think it's already happening. I mean, we've heard it from the management of these insurance companies that they are defending very aggressively now profitable business. And they know. I mean, they know it gets competitive at a certain point. That there is a point as this is as good as it's going to get, I believe, right? And so they do start to defend, and I think that's happening already. I mean, we know that that rate is well above loss cost. They say it. So they're able now to stay flat, even maybe come down a little bit, add a little bit, but really to defend, good books of business that now have been priced to the point where they're attractive enough for the carriers.
Well, thank you, David. As always, it is an absolute pleasure to have you on today's Viewpoint and for you to articulate to our viewers really what's going on in the broader insurance market. So thank you very much. David Paul, Principal at Alert Research. And to our listeners today, thank you very much and have a great day.